Okay, so how are you guys? My first of the new live rant, I guess, live stream. So yeah, so we'll probably have some software difficulties here because I'm actually doing the seminar as well as, or the webinar, as well as doing the live stream on YouTube. So if you're watching us from the webinar, it's best to go across to YouTube and then Brett's Property Rant and watch it from there because you'll be able to see the slides and everything like that. And yeah, so just that's probably the best idea if you're going to come across. But guys, what I want to encourage you to do is if you've got any questions, you know, whatever thing, put them into the comment section. And what I'll do is I'll go through my presentation, and then what we'll do is we'll go through the questions and I can answer as many questions as you've got. Just remember to put a Q in front of the question. But you know, you feel free to interact with other people and all that sort of stuff. That's fine. But yeah, guys, you know, you can start doing the questions whenever you want, but we'll get straight into it. So today, we're gonna cover quite a few things today, and really what I want to cover, and I guess the big question is, you know, recovery delivered or double dip. Okay, you know, have we already been through the worst of it, or have we got you know, a double dip to come? Now, it's interesting because technically it's not a double dip, and what I mean by that is normally a double dip is where we go into recession and we come out of recession and go back into recession. Well, we've only gone into recession, yeah? But because of the circumstances, you know, the question is that going to mean that we actually, you know, come out of it and that's it, and we won't go back into the recession, and now we're going to cover. Obviously, 24.4% drop in GDP. That's a massive, massive drop, the largest we've seen, and certainly in our lifetime, in any of our lifetimes. You know, so it is a big drop, and that's something that I think we've got to really, you know, give some credence to, because yeah, you know, it really has to be, you know, that sort of thing. So I think the key here is that what we're going to do is look at what's reality and what's perhaps may happen, and then sort of come at where we might end up. And I think that's where I'm, you know, aiming for today, is to give you some confidence, but not enough confidence to go, actually, we don't have to worry, throw caution to the wind. I think there's still a lot of things that can go wrong. I think there's still a lot of things that can happen. And I think really we've got to be cautious about the direction we go. But look, we're going to be covering stamp duty and the house price surge. Okay, I just heard there's echo on the stream. Yeah, all right. Let me just see. It looks like we've got, is there echo still on the stream now? You know what it is? I'll tell you what it is. There's not echo anymore. Sorry, guys. For some reason, my camera mic turned on, but we should have it. It should be fixed now. So apologies for that. But yeah, look. Bottom line is, you know, will pent-up demand save us? Yeah, and I'll talk a bit about that because I think that's really important to look at, and I think that is something that could actually really play a part here. Is the government really willing to go the distance? Well, they've shown that they have been so far, but is that going to continue? And I think that's really the key here. You know, planning, relaxation, and build programs, are they a good thing? And I think, you know, definitely is the answer, but we'll look more into detail on that. Second wave, you know, so second wave, are we going to have one? What happens if we do? What happens if we go back to lockdown? The unemployment rate, and I think that's really key. You know, I think for me, that is the thing that I am most watching. And before the unemployment rate, I'm watching the furlough and, you know, numbers of furlough, and I'm watching the actual redundancies. Okay, and I think if we look at that side of things, that gives us a good precursor to what potentially is going on. Okay, the problem is looking at what the government stats are. You know, do we believe them? Inflation, deflation, stagflation. Look, I'm not going to get into huge amounts of detail, but what I'm going to go and show you is the simple way that I look at where interest rates are going. Okay, and that really is because that's what's going to affect my mortgage payments. All right, and we can have a look at where that's going, and then we'll talk a little bit about the US dollar dependency and whether it's going to fall over and all that sort of stuff. And yeah, remember that thing Brexit that nobody's been speaking about, nobody's heard of since literally they said. But look, guys, I think you know, that's one of the interesting thing. Anyway, we'll look at that and the implication of that. Then Landlord's Corner. So that's a segment that I'll do every time, which is basically the evictions, notices, and making tax digital in 2023. So we'll look at that. And that's pretty much it today. And then we can, you know, obviously answer all your questions about where to buy, when to buy, how to buy, anything, you know. You know, it's an open floor, and you know, go for it. I'm happy to cover any topics today. Cool. So recovery or double dip. I think the key here, is actually double dip isn't even in the question right now because we haven't come out of the first recession. We're still currently in it, all right? So technically it's not. But I think the double dip is more of a figuratively speaking, where actually, we've come through, we've had the lockdown, which has dropped everything 20.4%, as I mentioned. The question is we've now bounced back and bounced back pretty well. Are we going to drop back again? Okay? And that really is a big question. And I'll tell you, I don't think anyone knows what the answer is. And the reason I don't think anyone knows what the answer is because it depends on the government and what actions they take. Yeah? And unfortunately for some governments, they're going to be quite restricted in what they can and can't do. Okay? And I think that's one of the keys. But in the UK, I think that is actually going to work well for us. And look, there's a simple way that I look at this, okay? And it's back in my day, I was a salesman and I used to sit there and, learn all sales closing techniques and things like that. And one of the things I used to be called was the Ben Franklin approach, all right? Or the Ben Franklin close, which is where you take the pros and the cons, and whichever has more, that's the side you go for, all right? Now, funnily enough, I didn't actually plan it this way, but it's come out on 5 on pro and 4 on that. Look, I'm sure there's hundreds of more things that I can come out. And the reality is I'm reasonably optimistic for the UK, okay? I think the US has got a lot of pain to go through, and I think that's going to be a real challenge for them. But anyway, we can talk about that, at length, no doubt. But look, I think that the interesting thing for me, for this whole game here is, look, house price surge in August. We'll go into that a little bit more. But I think the pros, there was a house price surge. People have confidence. Part of that is the confidence because of the March stamp duty relief. So, a lot more people aren't paying. And that really has stimulated the lower end of the market, which is a good thing, okay? You got pent-up demand, austerity for, 10 years. Brexit followed there for 3 years, really suppressed the market. And I think when you look at that, when you start realizing actually that suppression of the market really was a real thing, that's one of the reasons why we've had this bounce back. Okay, government willingness to support programs, affordable housing, 12.2 billion, of which I think it's 7 billion is going to go into new homes. Okay, so there's some good stuff there, and the relaxing of planning and building. At the end of the day, and this is the trickle down, and I'll talk about this soon, but the other side is second wave and lockdowns could really hamper everything. We just can't say. I know everyone says that everything has a second wave, but we just don't know that. Okay, unemployment, furlough ends. You got inflation, deflation, stagflation, all these sort of things, and the US dollar dependence, and possible move away from dependence, because a lot of countries now are deciding that may not be. So just looking at that, this is a good way to approach the whole thing, okay? But let's get into some more detail. So let's start off with unemployment, because for me, I think unemployment is one of the key metrics that you want to be looking at. If we keep the unemployment low, then actually we are likely to recover. If we screw it up and we get high unemployment rates, lots of redundancies, lots of things happening like that, people losing their jobs, then we're likely to double dip, or we're likely to continue into a drop. So I think that really is, for me, the biggest determination. We can go on government debt. We can say, there's so much government debt. The reality is if you look at the US, they are leading the way in spending and printing money. And, they've got away with it for a whole decade. In actual fact, they've got away with it for a long, long time. Yeah. Now, they are the reserve currency, but a lot of countries now are seeing that they can print money and it doesn't have the sting in the tail that we, perhaps thought it was. I know when I learned economics, it was pretty much, if you print too much money, you end up with hyperinflation. But that was back in the 80s when I was learning, it was 80s. It was back in the 80s when I was learning my economics, 101. And basically things have changed a lot. Our understanding has changed a lot, okay? The fundamentals still remain the same, but we've got a lot more, advanced in our understanding of that. So, yeah. But look, current rate, interestingly, 3.9. And I think the other thing is 3.9 there, but that 3.9, hasn't really changed. Now, why is that? Well, to June, it hasn't changed. That's because the furlough scheme perhaps kept a lot of people. So, jobs were being created, less jobs were, getting let go. So, because of that scheme, a lot of people kept their jobs. And that's why the lockdown was actually a relatively positive experience, unless it was a really negative experience and you did lose your job. So it hasn't really come to fruition yet. we're going to see what happens now in July and August, now that you've got to pay the NI and pay-as-you-earn element, and then another 10% and 20% to see what happens, okay? And if we look a bit further into it, okay, coronavirus, 300,000 redundancies planned in June and July. Now, this article, okay, the reason they can say this is because what happens if you in the UK have over 20 redundancies you're making, you have to report it to the government, okay? So you can see 300,000 redundancies. That's a big hit, okay? And, this is under 20, so how many businesses that have under 20 staff and are maybe getting rid of 5, 10 or whatever, who knows, okay? So, we can look at that, and that really, can, skew things, all right? So, yeah, and if we look at planned redundancies, you can see they've jumped up, that's 2019, 2020. So you can see, this year obviously are going to be bigger, So, look, I think, and actually that's a really good question from Ritesh. What is the actual, what does the recession mean for property investors? Look, it really depends on your individual circumstances. It means potentially there's going to be opportunities. It means potentially interest rates are going to stay low. Okay, so your cash flow should be okay. But it does mean that your tenants could lose their job and stop paying the rent. However, and this is what I'll say is, when we went into the recession, we told people if people weren't going to pay, if tenants weren't paying, get that payment holiday underway. And I'm still saying it to this day. Even though a lot of people think that the first 3 months it's ended, it actually hasn't ended yet. You can apply to your funder and say, I want a payment holiday because of my thing. And for any of our tenants, any of our landlords, if you're having difficulty, you need a letter to send to your mortgage company. We're more than happy to provide a letter that just basically says, hey, this is where it's at, and please grant them an extension, and certainly, we're negotiating, and that's actually one of the things we'll talk about a little bit later on, is we're doing a lot of work to make sure we work out and understand where the tenant is at, and then work out where we can go from there, okay? And I think that's one of the keys. It's being said a lot, but look, in terms of the recession, the real risk for property investors is not so much on the cash flow side, I don't think, although it could be if things got really, really bad. But certainly the government seems to be indicating that they'll do whatever it takes to support the housing market. And if that means that there's lots and lots of tenants not paying and all this sort of stuff, the potential is that they will come in and support those tenants because they don't want an eviction crisis, okay? In which case the landlord gets paid. So that's good. So there's a number of things. The real, I think, effect is, number one, is if you lose your job because of the recession, okay? But then we have, and there's a calculator on the website, if you go to tools onto our website, gladfish.com, and go to the menu and go to tools, and you'll see what happens, it's a scenario, what happens if you lose your job. And you can plug in some numbers and see what if you get your job with 30%, drop in pay over 3 months, that sort of thing. You can play with those numbers. And I think that's really important. The final thing is that capital values drop. Now, I'll leave the rest of that for a little while. And the reason I'll leave for a little while is because we're going to deal with this towards the end when I talk about different areas and why I think you should be investing in certain areas and not other areas, okay? The unfortunate news is if you've got stuff outside the major cities, the trend is not good long-term for those, okay? Even though, we're talking about working from home, even though we're talking about Zoom meetings, even though we're talking about all these trends, which should see people be able to stay out of the cities, the reality is people want, what's going on with the cities, and they're attracting the talent, and they're attracting stuff that's going on, and that's all the fundamentals that mean house prices grow. So, but we'll talk more about that particular question most definitely. Look, guys, so that's, redundancy. So the issue is unemployment rate hasn't hit yet. Redundancies are being talked about. We haven't actually seen them come to fruition yet. As more data comes out, we'll start to see, and that will give us a better indication of where we're at and how well it's recovered. But let's have a look at some other stuff. So consumer spending is still well below typical. Now, we've got the zero line there. Okay, so the zero line is through the middle. Anything above the zero line means that it's better than last year. Anything below means that it's worse. Now, obviously, March, April, May, June, and even July are much worse. But things have come back. You can see the airlines there, minus 80%, minus 60% still, minus 50% still, but interesting, if you've got a nursery or home and garden, you're quite laughing, because obviously being at home, people go, you know what, we want to renovate the house, we want to do the house. And, I've had a number of people who have gone after that and gone for that, which is great news. So I think the key really here is with the government spending is things aren't as good as they were. We are in a recession, but I think part of this is people are starting to go, you know what, I don't need to spend all my money on all this other stuff. So there's been a restriction of the spending, but there's also been a realization of the consumeristic society. And I know I have this conversation with lots of people, about how they've stopped spending on certain stuff. But then the other side is there's still the people that are now buying online. I mean, Amazon grew the equivalent, what they thought they'd grow in 10 years, they grew in 4 months, they reckon. And that's why, he's a bazillionaire. It's just, incredible, because deliveries, and that sort of thing. So people are still spending, but they're not spending at the rate they were, which that's to be expected. So I wouldn't be too worried about the consumer spending right now. But what it does mean is we're not going to bounce back massively. So if we're talking about a V shape right now, I'm not sure we've got the V shape back yet. Yeah. People are taking longer to return to high streets, in London and other larger cities than smaller towns. Now, this is one of the keys. So I thought this. If you go through a walk through London now, what happens? It's not as busy as it was. However, if you look at some of the smaller towns, people are returning to the small towns. I mean, it's interesting. I'm in Singapore at the moment, and what we're finding is a lot of the little cafes now are actually bustling. They're as busier than they ever were. Partially because people are working at home still, and so they want to get out. So they go out for their morning coffee, or they go out with their laptop and do some work in the coffee shop. So those sort of smaller places are benefiting. But if you're not going into the city to work, and let's face it, there's 8 million people in London, 5 million people live in London, and 3 million people travel in each day. So if those 3 million people aren't coming in, or a portion of them are gone, that's a big hit to the economy. And that's what's happening with the major cities. Okay, so again, it's not that people are just staying home and not spending, but they are taking, London and the major cities are taking longer to come back and to recover. Okay, now that will mean loss of businesses, that will mean loss of jobs, that will mean all that sort of things. So I'm not suggesting for a moment that things are just going to tick back up and everything's going to be great and we can put all coronavirus behind us. I don't think that's the case. Okay, but I also, for the UK, don't think that we're necessarily in for this massive thing, unless America does a total nosedive. Everyone decides the US dollar's not that. China decides to dump all their US dollars on the market, and these are all worst case scenarios. And what I tend to find is when I'm doing predictions and things, worst case scenario generally doesn't happen, very rarely. To get one worst case scenario, maybe to get 2, 3, 4, 5, which might cause a drop of 30% in house prices or whatever. I just don't see that as happening, okay, in this circumstance. I think the government is willing to do what it needs to do. It's certainly said that, and it's backed it up. So this is an interesting graph, because this is, if we have a look, some sectors have seen their operations resume, others are largely still shut. So the interesting, if you look at all sectors, you've got the turnover down, which you'd expect, okay? You've got on furlough. Now, furlough's starting to drop off because it's starting to cost money, so people are coming back, temporarily closed, The little red line is those made redundant. So as long as that redundancy doesn't jump up massively, we're probably going to be okay, all right? So, but you can have a look in some of those things. I mean, look at hospitality. That's a big hit and an early hit, but they were shut down totally. You got things like professional and scientific haven't really been touched. You got retail has been, manufacturing. But a lot of these, if you look, construction, manufacturing, retail, they haven't yet recovered. Okay, if anything, health, IT, have plodded along because they haven't been affected too much by it. Admin and support. There's been redundancies made. So a lot of this sort of stuff is happening, but these are just, none of these are really, they're what you would expect. They're not actually, oh, this is tragic and this is, gonna, turn to crap. All right. Now, interesting thing is, and this is one of the things I use. Okay. So if we have a look here, this is basically off Nationwide today. Okay. It's their current mortgage rates, but you can do this with any mortgage company on their website. Yeah. And just see because what you're doing here is you're looking for risk. So what I'm going to look at in this is I want to see what I think long-term interest rates are going to do. Yeah, so I can make my decisions based on my portfolio. So a lot of people are saying, oh, there's going to be massive inflation. Now, if that was true and there was massive inflation, okay, then we would expect today's interest rate to be low, tomorrow's, 2 years, 5 years, 10 years to be much higher. Maybe not 10 years, that's quite a way away. But certainly 2 years and 5 years, you'd expect a massive jump if you're expecting lots of inflation. Yeah. So if we have a look at this, and let's look at the 2-year fixed, okay, with no product fee. So right now that's at 2.24%. Yeah. So in other words, they're prepared to guarantee for the next 2 years, 2.24%. Okay, with no product fee. All right. Then now let's go to the same product for 5 years. So that is now 2.39. So it's gone up 1.15%. In other words, hardly anything. Yeah. So that's important. Okay. Hardly any increase between 2 years and 5 years. So the prediction from that perspective would be that things are going to remain relatively flat. Now, the other side is it says that actually we could be in recession. They could be predicting recession, and their rates aren't going to drop below zero because they're at 0.1 now is the base. Yeah, so they might be expecting that it's not going to really go up at all in the next 5 years, or very little. Okay. Now let's go to 10 years. So if you look at 10 years for same product, 2.59. So a little bit higher, but still not actually that bad. So now if you think about it, 10-year fixed, that's not a bad. If you can do it at 2.59. You know what? That's not a bad rate. Yeah. So the question is are things going to drop? What they're saying is that effectively just with this basic, and it's a basic look at it. Okay. What they're saying is that rates aren't going to go up that much over the next 10 years. Yeah. Now that's really, that's either really bad news because it means that interest rates are going to drop dramatically, that the economy is going to drop dramatically and they're going to keep their rates roughly where they are, in which case you probably get them around the same, or by increasing them slightly means that over the next 5 and 10 years, 2, 5, 10 years, we're going to see the recovery, but it probably isn't going to be a massive increase. Now, unfortunately, if you're a pensioner and you're relying on pension income and you're relying on income, that's not a good news because that means interest rates are going to be low. And if you're relying on a share scheme or something to pay you that, you're really going to be suffering. Okay? So that, I think, is telltale. But you know what? None of this is news. Yeah? None of this isn't something we didn't expect. Pension returns have been diminishing. And, we used to do this where we said, if you take whatever capital you got, multiply by 5%, that's your annual income. Yeah? But the reality is, nothing much is actually, nothing much there is a surprise because we already knew that. We're already saying now that the potential, it used to be you'd say about 10%, then it went to 5%, and now we're saying potentially it could be 1 to 3%, and probably more than 1%. So what does that mean? Does that mean stagflation, is being predicted? Potentially, not entirely, I don't think. And the reason is quite simple, is that I think there's a disparity between the towns and the cities. And I think this is going to be the competition that's going to come out. You'll have house price growth in the cities, but not necessarily in the towns. So Ashley just put a good thing, so I'll just answer that. Cheers, Ashley. Will we need high deposits to buy UK property? I don't think we will. I mean, if you think about it, the mortgage market review back in, when was it, 2010, I think, or 12, or whenever it came out, it may have been 14 by the time they got it done. But yeah, bottom line is this is what they suggested. And remember, even though you've got to put so much commission, so much deposit in, you still have the affordability aspect. So the two balance each other out. And actually, to be fair, across all the markets that I've ever dealt in, I've never seen higher deposits have to be than what we've got now. So normally what happens is when times are really good, you loosen the criteria, which means you can get higher loan to values. Yeah, but because of the mortgage market review, the European one, okay, it meant that the loan to values actually dropped and you had to have more deposit, okay, and then you add the affordability criteria over the top. And so, between those two, we're already in a situation where you need higher deposits. Yeah, you used to be able to buy and buy and buy and buy. Now, actually, you need a lot more equity before you buy your next one. Okay. Now, some people argue and say, but hold on, if I've got a high yield and blah, blah, I'm not going to get into that because there are instances where, yes, you can build them quickly, but they're generally low value stuff. Okay. And really, that's not the market that I go for, that sort of thing. So will we need? I don't see it. Okay. If anything, when coronavirus hit, what we saw was things drop, and then basically what we saw was things, the loan to values drop, but now they've started to come back up again, okay? But what we have seen is the number of products, diminish, but even those are starting to come back now. So, and that would be an indication of recovery, not of double dip. Yeah. So far, hopefully I'm giving you a reasonably confident picture, not a confident of this, yeah, but a confident of this, and maybe going up, but not probably that some people may be saying. But as I said, worst case scenario, we may end up in some of those sort of things. All right. Okay. So let's talk about the positives. Look, house price surge, yeah, record high in August, so and pretty much everybody's doing this. My other side is, as much as I'd love to say as an estate agent and all that sort of stuff, it's great, recovery, fantastic, get your house now, get in and buy before they go up. I'm more tapered and measured about my thinking about that. Yeah, I'm not sure that is the is the case that it's great. I think there was a pent up demand around austerity, around Brexit. There was an indication by the government that they were going to support the housing industry, that they were going to make things right, they were going to do things that want, they were going to stimulate the economy, they were going to build, they were going to fix the planning issues, they were going to do all these sort of things, and they started to do them. And because of that, actually, I think that was bloody fantastic. Yeah. So look, guys, if you go on to gladfish.com/predictions, you can actually get my regular predictions that I make. Okay. Any prediction videos I do, I chuck them on there now, and that's pretty much kept up to date as we do them. But I think, it's good news. It's great because it has rebounded the thing. It's given the industry a lot of confidence. But I also think there's some overconfidence there. But there is some good news, and that's the next thing that we talk about, which is that basically the government's announced $12.2 billion for affordable housing, of which I think it's $700 million of that is for new homes. Okay. Now, the interesting thing with this affordable housing, okay, this is an issue, absolutely. And I think, Kate Barker in 2004, I think, or 2002, she came out with the Barker report, which basically talked about how there was a shortage of 200,000 homes and we need to do 150,000 homes or whatever it was every single year, and we've failed to do it in any of the years. And I've been in the UK since 2002, and they've never done it in a single year, not even got close. So now that 200,000 must be a million. I don't know how many homes the shortage there are. I'm not sure the government statistics or those figures are totally correct. I think, is there enough affordable housing for the lower end of people, for that? And is there the schemes to get people on the housing thing and the commitment? No, I think that's where there is. I think there's plenty of homes, in the right brackets, in, normal people that are employed, that sort of stuff, So I'm not a big proponent of this. There's a housing crisis. I think the housing crisis is that the government doesn't want to spend its own money to create a two-tier housing system, okay? It's almost like they want industry to do it. In Singapore, they have what's called a HDB, Housing Development Board. They create a two-tier system, okay? That, HDBs are what everybody can afford. They're subsidised, they're that. But any money you make out of that effectively has, goes back into that. And so it basically keeps the prices down so everybody can afford them. And it's a great system, yeah? If you want to go private housing, then private housing can go up to millions, 30 million more even, But the reality is, it's a great system, works very well, and the UK could learn a lot from that. But I'm not sure that the government wants to put the money behind that, and I feel the big businesses, the big corporations and pension funds are what are taking over that market. And not only the private rented stuff, but not so much the affordable. I think the government should provide the affordable, and it should be an affordable house, not the local developers. The developers can build it, they could, although we can have a discussion about that. But the good news is that they are throwing money at this. Now, the great news about this, added with the next thing that we'll talk about, which is, now, actually, before I talk about this one, which is slums of the future may spring, from relaxed, planning rules. I mean, what a load of crap. It's typical friggin' England news, isn't it? Negative. It's a friggin' positive. I mean, number one is they're talking about how, conversion of commercial, which is permitted development, but they've got a new home there, picture. So clearly the journalist doesn't know what they're talking about for a start. But anyway, let's not get onto that. Bottom line with this is, by relaxing the planning and putting money into housing, that money, rather than going at the top and trickling down, which it never does. That's what the US does. And watch the billionaires get multi-billionaires, and everyone else just suffers. Okay. However, if you put it in at the bottom level, which means if you build new homes, if you give it to the plumbers and the carpenters and all these sort of guys, that actually can be a fantastic result, because what it does, it puts the money into that part of the economy. They go out and spend it at local shops and local things, and that keeps the economy moving. This is the best way to ward off a double dip, a bad recession and that sort of stuff, is put the money in there. And that's something the furlough system, the furlough system and the universal credits and all these sort of things has done. It's put money into people's pockets. And I think that, above all, is absolutely the best thing to do. Okay, so Boris, Rishi, keep doing that. Yeah, keep doing that, because that'll keep stimulating. And I'll just say, guys, if you want to learn more about development and that sort of stuff, then go across to, just type in Straight Talking Property Podcast with Ash, myself, Jimmy, and Emmanuel, and we basically talk about all the planning issues and that sort of stuff. So that's quite good. That's a podcast. But also, if you're interested in investing in developments and some of the stuff we're doing from that side, you can go to gladfish.cc. Okay. And that's the website. You've got to be a high net worth or sophisticated investor, otherwise we can't really talk to you about those opportunities, because they are for those guys. But you can jump across into there. So let's move away. So that's what for me, looking at that big picture, I'm not hugely optimistic. I'm not going to say everything's rosy dandy. Go out and buy 15 properties and tweedledee, tweedledum, whatever. But I'm also not of the opinion that things are going to drop dramatically. Yes, there's worst case scenarios that could happen. I don't think they will. Okay, I think that's less likely. But let's talk about a few things. So Brexit. We've still got Brexit. We've left the EU. We've got this transition period. We've got to have it done. Otherwise, we're going to do a hard Brexit. I think a lot of the news media about this has been wrong all along, and I've said this for ages, is that I actually don't think it's been as bad. I think it's been really poorly managed. Well, I think it's been really well managed by the media, okay? And what I mean by that is I think in terms of getting column inches and people whipped up into a frenzy, they've done the right thing. Perfect, flawless. But in terms of reality, they've been off with the fairies. The reality is things have never been as bad as they were made out to be. And I think that's actually the reality of this, is they're not likely to be as bad as, they're made out. But look, guys, it's coming and it will come, and I think they'll sort it out. But they're talking about, the UK needs to be realistic. They're saying, look, at the end of the day, this is just all posturing and this is deal making. They'll pull a deal off, I think. I think they will. It's not in anyone's interest, and you don't want to be a politician who screws this up and then causes, effectively could double dip the recession in both countries. In Europe, which is teetering on, total annihilation, and the UK, which is, in the worst recession or worst drop it's ever been. And in fact, the worst drop of any G7 nation, But yeah. Okay, so let's talk about the landlord corner. So, look, there's a heap of detail here, but I'm just going to go through it quickly because I don't want to get into too much detail. If you want more detail, there's plenty of stuff. If you go to gladfish.com/recession, there's all my videos about the recession and things that have been going on and things that are likely to happen and that sort of stuff, okay? Or you just go on the website, gladfish.com, and you'll see it. There's property TV, there's, my videos are everywhere, including this YouTube channel, okay? But what you'll find is that oftentimes the YouTube channel doesn't have everything on it, but the website will have everything on it, okay, including courses and things like that. Tenant evictions. So originally it was supposed to be 23rd of August. They U-turned literally the day of. I think it was the day of. It was due to come into effect on Saturday, and on the Friday they did it. And they extended it for 4 weeks to the 20th of September. And so what they've done, so they did that, and now what they've done is they've changed the notices, which we'll talk about in a sec. But what it does mean, if you had something going on now or before, it stayed. In other words, if you don't do anything with it, it's gone. Yeah, you have to restart it. So part of the restarting is you have to identify what the impact of coronavirus has been on your tenant. Now, it doesn't say what you have to do that, but basically, if you send an email to say, "Hey, how you doing? Hopefully coronavirus has treated you well, or not too bad," then that's probably all enough. And the reality is, if you're going for eviction under mandatory grounds, they can't deny those mandatory grounds. Yeah, so they have to do that. But remember, you can't reapply until the 20th of September. And on the 20th of September, then you've got to get into court, which the court's going to be so backed up, you could be another 6 months before you get into it. Hopefully not. Hopefully some of these Nightingale courts will think, but they're only going to look at massive arrears and antisocial. Yeah. So if you've got a little bit of arrears and no antisocial, and let's face it, antisocial is bare near impossible to do anyway. Okay. It's a hard one. One thing we are doing, okay, and we're jumping the gun a bit by this, but I think it's worthwhile, is that with the new notices and the 6 month notices, and actually I'll go to the next one because I'll talk about it there. Sorry, I put this up the top, haven't I? There we go. So with the tenant notices. So tenant notices, okay. Now Section 21s, which is basically no fault, ending the thing, or no fault eviction, which basically says, get out of my property, I need it for whatever I want to do it. I don't need to give you a reason. Now have to be 6 months long, so you have to give them 6 months notice. So they're still there. They may still be removed, okay, but I think that's still the intention, but hopefully not. Hopefully they sit with 6 months. That's, fine. It was 2 months, it's now 6 months, okay. Arrears ground 8, 10 and 11, which don't worry about their ground so much, but basically if you've got less than 6 months of arrears, then you've got a 6 months notice. Yeah? If you've got more than 6 months, then 4 weeks notice, okay. But what it means is potentially you are funding that tenant for even longer. There are tenants out there that have just refused to pay, which is a bloody pain in the ass. And basically, it's shocking, to be fair. So look, bottom line is, for me, is get your rent and legal insurance. If you can get it, because that will cover you. It's likely to go up in price because obviously the time that it takes to get people out is taking longer, but definitely. Antisocial, it's interesting. Antisocial, they talk about antisocial being, there, but it's so hard to enforce. It's so hard to enforce unless the police go round there and actually convict, or the council does a conviction. It's very hard to do anything. Try getting your if your neighbour makes a complaint to you as the agent, and then you raise it with that person. Try getting them into court to complain about the person, because the likelihood is there's not going to be a mandatory ground, and they're going to be stuck in the property, and they're going to have to live next to that neighbour. So it just doesn't happen. So coming back to the mediation, the one thing we are doing, and the one thing we did very successfully, I have to say, and the team, all credit to the team for this, is we got a system of communicating. So when people went into arrears because of coronavirus, we got them onto a payment plan, and we got them to stick to that payment plan, a realistic payment plan. And our arrears are very small. I mean, we're talking over 1,200 properties, yeah, and we have 3 tenants that we need to evict, yeah, and they are tenants that are refusing to communicate, or realistically are just refusing to pay. One of them we've already got a high court order against, but they haven't been able to enforce it. So she was due to get chucked out just after the lockdown, and of course now she's got an extra 6 months, potentially longer, which is just disappointing for that landlord. But yeah, so what the mediation service is basically, rather than wait for the court to handle it, just accept that you're going to make a loss. We'll negotiate as minimal loss as possible and get them out of the property, or get them onto a payment plan, or get them onto something, so that they're actually paying. Maybe we increase their repayments in rent for a period, and we forgive the rest of the debt, but basically negotiating that up front before it becomes a problem for us, and I think that's key. The unfortunate, that's what the government is forcing us to do, and unfortunately it means that landlords are going to have to pay more, and that's why I say rent and legal insurance. Now guys, obviously I own EasyTrack, property management. If you've got any questions, concerns, go to easytrack.co.uk. You can go onto that website, you can speak to the team. I'm in a team in Gladfish, they also know lots about this and that sort of stuff, and how we're dealing with it. All the team are up to date. But if you're having problems, certainly if you're with us, we'll all be dealing with it. But if you're not with us and you're looking to bring your property across, then we're happy to deal with all that sort of stuff. But yeah, so let's start to finish off. So let's talk about areas to invest, yeah, because I think this is really important. And I think the thing for me is, whatever happens, there's still going to be opportunities, and I think that's one of the keys here. Look, I would love to say that, just go out and buy whatever, but I don't think that's the case anymore. I think the trend now in the UK is that the towns The fundamentals just aren't there. There's not the money getting spent. There's not the change, fundamentals. It's just not a functioning market anymore. So you've got to be really, really careful. Now, sure, if you're just going for a cheapy, best yield, strategy, fine. Okay, go out of that cheapy stuff. But certainly, I like to have both. I like to have the yield and I like to have the capital growth potential. Because yes, you may go, well, I'm making this much and I'll pay my property off in 10 years, but you're going to pay it off in 25 years. Well, actually, yeah, I am, but then I could probably sell it because capital growth, So it depends on your strategy. And, if you want to know about strategy, chat to the team. You can go to gladfish.com/portfolio-management, book a portfolio strategy meeting with the team and they can go through whatever, the current market strategy, all that. So where should we invest? I am a big, and if you look at where we're sourcing now, and I'm being really, really pig-headed about this, even to the point of where, some clients are like, well, I don't want to buy in those areas because I want something cheap, and I'm like, I'm not going to source in that area because I know the quality of the stuff, But, London always, if we do go into this, it bounces back the quickest, because it has the best fundamentals. There's huge amounts of money, regeneration getting spent. There's all sorts of stuff like that. And I think that's really key and really essential with this. Look, so there's that element. There's the other element, which is Manchester, Birmingham, Liverpool, those sort of places, which are your major cities. And I always say major cities with universities, okay? One of the things I'm one of the things I'm really impressed with is back in 2012, okay, when I first moved to Singapore, we were talking about London being the world city. Yeah, London being a world city. It still is. But now Manchester and also Birmingham have both been added to that list. Yeah, and to a degree Liverpool, but not as much Liverpool. Okay, so those areas you've got to be, you've still got to be careful. And the other side of it is, so there's the area you want to invest, but there's the type of developer you want to invest with, and the type of, if you've got an existing property, fine. Get it inspected, make sure you get rid of all the problems, and you know of those before you invest. If you're talking about new build, go with your proven developers that have got a track record of experience and do your due diligence. And if you do that, you should be relatively fine. Yeah, you can negotiate now, but obviously, some developers are, a bit confident. But the one good thing about this whole thing is that with the relaxation of the planning things, what's actually happened is lots and lots of sites now are being bought out and getting converted to properties that are in the town centres. So the town centres are going to change from where, high streets were desolate, boarded up and all that sort of stuff. Now there'll be a renaissance, if you like, of the high street. Not in retail. Yeah, retail's moved out. Yeah, now it's all about distribution to get to the where people live quicker. And that's part of what Amazon and their success is. But certainly in the high street, what's happening now is a lot of those commercial buildings are getting converted to residential through permitted development. So the government is relaxing the rules, but you know what? This is the stupid thing is the relaxation of the rules isn't actually in such a way whereby that you still have to go through and meet various requirements. It's not as simple. I think people think with permitted development and with developing now, it's like they've relaxed the rules. Oh yeah, we're just going to go and build whatever we want. No, you still have to meet minimum requirements, fire standards, building standards, codes, all this sort of stuff. You still have to meet all of that stuff. Yeah, it just means that you don't necessarily have to go through the whole process of a full planning application. Okay, so there's still a lot to do. It's not an easy process. And, this is where I find some of these weekend warriors. And what I mean by that is these guys that go along and think, I'm going to become a property developer. I'll send a weekend course. And now I'm a property developer. Let me go and find a property. And, and they just think it's easy. And it's not. So you've got to be careful with a lot of those developers that are just starting out. Because even if they're on their first or second or third, they may not have learnt the lessons. And they probably haven't lived through, the ups and downs of the cycles and the fact that, look, one of the interesting things is, look, bottom line is what we're going to see is this, yeah? Right now, lots and lots of permitted development happening, yeah? Lots and lots of sites getting snapped up. Now, what happens is they then put it into the architect, they get it all done, and now they start building it, yeah? So what happens when they start building it? When all these people start building new homes, all of a sudden there's a labour shortage because guess what we did with Brexit? And guess what we did with immigration? All the cheap labour went back to Europe. And so now what's going to happen is build costs are going to go up. And a lot of those builders won't have accounted for that, and they won't, have allowed a margin enough for that. And then they'll either decrease the quality of their stuff, which means you end up with a crappy property, or they just will go bust and somebody else will have to take it over and build it out. So, but then what will happen is then you'll have all these come to the market, and that market will then drive things up. But that's a good functioning market, and you expect that. Okay. So for me, the market actually is functioning really well. It's, yes, there was some pent up demand. Yes, there's some stamp duty stuff, but the stamp duty stuff, it will end and the market will continue. And I don't think we're going to see 30% drops like some people say. I just don't. Now, interesting, Ritesh has just written, should I expect 10 to 20% discounts? I don't think so. I think if a couple of the worst case things hit, we go back into lockdown, construction sites, and it gets really bad, and we don't find a vaccine, well into next year, then potentially, yeah, there will be some desperate, things. But I think we're likely to sit around, like where we are now is probably the 5 to 10%, is what you can realistically expect. And I think that's where it's going to sit, because most developers are happy to sit at that. Before Brexit or during Brexit, they were selling at this level. And so actually now, they've been selling at that level. Now, sure, it's slowed down for a little while, but for the most part, they haven't needed to give away the big discounts. And we're not seeing that, which, is actually, I think a good thing, So guys, any other questions? So that's my, hopefully that's, a bit of a summary for today. Or for this month. Look, what do I think? I think right now things are looking pretty good when they could have been absolutely a shambles. Yeah, and I think that realistically is we had austerity followed by Brexit, and then all of a sudden we had new government come in that said, no, you know what? Now we're going to spend money. Now originally they said that without the coronavirus being there, so there's been a lot of money spent on coronavirus. But they've still maintained their commitment and their willingness and, to actually keep doing that, which is great news. Okay. So I think that's absolutely essential, and I think that's where we have to really, count our blessings for that thing. Because I think really that will see us through. Now, will we hit, a lot of people saying, oh, but then we'll get into the winter period and things will drop off. Yeah, they will. But that's normal. That's the market. They do drop off. So I think that's one of the keys too, is we will see this spring bounce, this August, massive, jump. That's going to wane now. But don't think that's a wane because of coronavirus or anything else. That happens every year. November, December, January are always dead. February, even into February a little bit, it starts to pick up again. But, it's not until realistically March, April where things now go and we have the spring bounce. Okay. So, guys, hopefully that gives you a bit of a indication of where the property market is and my thoughts for this month of September. And we'll watch the news, and the stats that come out, on consumer spending, on redundancies, on unemployment, and all these sort of things, and keep you up to date. But yeah, any other questions, post them in the chat, and I'm happy to answer them. For any of you guys that are over on the webinar, can you might want to come on to the thing, because I think you've missed the questions. I don't think you're getting the questions there, but yeah. Rachel, so should landlords be expecting to negotiate lower rents due to renewal during this period? Okay. The answer is yes, but it depends. So what I mean by that is this. Okay, so if you look at what happened when we're in lockdown, yeah, a lot of stuff, rents started dropping. But that was because what happened, the service accommodation, which was massive, okay, in London, all of a sudden, they couldn't get anyone. There was no travel. There was no one moving. There was no one taking those things, And a lot of them said, okay, I'm going to get hospital workers, but they didn't need the hospital workers in the end. So, so the service apartment industry, I've heard up to 60% of those have now gone onto the regular market. So that's a massive flood of property that have come onto the market, yeah? And certainly where they had lots of service apartments, that's where we've seen those drop in rents. But there's just as many rents that have stayed the same, gone up a little bit, it hasn't dropped dramatically. But in some buildings, and really it's a building specific. So if you found that you had a lot of service apartments before, what you found is your rents probably dropped, 200, 300. dramatically. But now what you'll find, once that supply is taken up, then what you're likely to have is actually the rents come back. So it really depends on, lettings is a week by week market. Yeah. So if in 1 week there's 10 properties and 2 of them get let per week, let's say, so over the next 5 weeks, but let's say you're number 10, and so on the 5th week, another 10 come to the market. Now you've got 11 on the market. You could be, another. So it depends on that. Do I think that, you should be expecting to negotiate lower rents? I would say probably in London, let's say 5%. Outside of London, we haven't really noticed much of a difference, But by the same token, what we are doing, and our new system the new process where we're actually going out and we're doing automated valuation models. We're using an automated valuation model. We're doing reports. We're getting lots of research and that sort of stuff. We're able to see where your rent is compared to others in the building. Because a lot of the buildings we manage multiple properties. We're talking 5, 10, 20, even 30, 40 properties in developments and things. So we can see what other people are getting and we can negotiate based on that. And so some of that data we're using to send to the tenant and say, hey, this is what we're currently getting on these, so we need to bring this up, and we're explaining it to them. And, and part of it is we're saying this is what we're raising it, but then we negotiate it down to, whatever. So it's a negotiation as much as it is, the fundamentals for that particular week by week market, which all rentals is a week by week market, supply and demand, that sort of stuff. All right. But there's actually a lot of videos that I'm putting out on the letting side to talk on how we actually operate and how we do that. Because what we try and do is, if that's a realistic market rent, we put it here and then we drop the rents. Now, a lot of other agents are like, oh, look at them, they're dropping the rents all the time. It's like, yeah, we are, because we start higher and we're going down to where we think it is. Whereas a lot of agents will, if you say you want 1,500, the market's at 1,300, they'll start you at 1,500 and they'll leave you until you come to them and say, hey, we need to get this rented. So yeah, hopefully that gives you a bit of a understanding. I think you may find that your rent drops depending on where it is and when it was and all that sort of stuff. So there have been rent drops, absolutely, but not as dramatic as some of the news has been saying, and certainly not as dramatic as some of the service apartments that I've heard, where, some of them, they haven't even got their property back yet. And the worst thing is because of the way they've done the tenancies, they're struggling to get the person out of court, into court to get them out, so yeah, but no, so hopefully that answers your questions. Guys, any other questions? So I'm happy to keep talking forever and answer questions. Well, maybe not forever, but certainly while the voice continues. But yeah, no, nothing. Well, that's what is that? 57 minutes. So it's a nice little chat. But yeah, guys, look, I'm here. So I'm actually doing Wednesday every week as a live stream, and then once a month I do the full market review. So we're going to start building up the live stream and having a bit of fun. So we'll be, I'm getting the new software working, and we'll get the webinar software and that interacting. But look, guys, any questions you've got, you can also send in any questions you've got. Either comment in the subscribe and comment on my YouTube channel, or if you want to, you can just send into webinars@gladfish.com. And if you send to that email address, then that will come through. And what I do is I actually record a video, and then I can send the link to that video back to you, so I can answer your questions specifically. And what I generally, I'll publish that so everybody gets the benefit of it. But if you've got specific questions, you can also speak to the team, and they can guide you through, because I think that's really important now, is to get really good quality help and advice and support, but up to date. And I think one of the problems is you've got a lot of companies out there now that are just focusing on making sales. And I think, that's, some of the stuff and some of the areas they've got in aren't really the best areas. But, it's interesting that there is, looking around at what's happened around the world, most countries are equalising their tax. And what I mean by that is that, it used to be that the UK tax was actually quite cheap compared to everywhere else. Now you're finding they're adding layers of tax, which is only bringing it to where a lot of other countries are too. So that's just part and parcel. So there is changes, and there's more changes that come, and I'm sure there's more and more changes. There's more compliance. But, if you're working with EasyTrack, if you're working with my team, we're keeping up to date on this. and we're 100% on top of that. We've just appointed a director of compliance full-time to handle all of the compliance and make sure we're up to date and all our landlords are safe, because you just can't risk it anymore. So awesome, guys. Well, unless there's anything else, I'm happy to call it there. And but any comments, put them in the thing. I'll stay around for a couple of minutes after, and just in case there's anything else pop on. But otherwise, you can contact the team, gladfish.com, and then you /meet a or book a meeting, book-a-meeting, and speak to the team. We're always available. In fact, even we've got the live chat now, so you can actually live chat. And so half the time you'll probably get me, because I'm playing with it and we're getting our questions and answers banks, up. So that's quite good. But there is a lot of stuff that's happening. There's a lot of videos that I'm doing around the compliance side, around the technical side, around why we do things the way we do them, and why a lot of those things are different to what an average agent will tell you. But to be fair, my way works a lot better than theirs. 25 years experience of doing this. We must have done thousands, tens of thousands of rents now. So I think that's that really is starting to come to play. And there's a lot of. We're opening the London office. We've moved office in London now. We're now Pentonville Road. Clerkenwell Road, in Farringdon, right in the centre. And we're basically now going to start lettings. So we've got a number of people we're employing in lettings. So we're lettings. We've got 700 of our properties are in and around London, in central London. So, it's a massive amount of stuff. So we'll be handling that in the near future. So it's a really exciting time, actually. Despite all this sort of stuff, one of my attitudes has always been, this is the time to make the big plans, big audacious goals, as they say, that scare the crap out of you. But good, guys. All right, thank you very much. I'll call it there. And look, any other questions, send them through webinars@gladfish.com. Otherwise, have a great day. Live with passion. See you later.